Welcome back. In this lesson, we'll talk about equity. Let's take a look at the stockholders' equity of Adobe. The three main components of equity, as reported on the balance sheet, are the preferred stock, the common stock, and retained earnings. And there are other accounts related to common stock, such as additional paid-in capital and treasury stock. The preferred stock is a stock that has no voting rights, it usually pays fixed dividends, and the holders of the preferred stock have a priority over the holders of common stock when it comes to the dividend payments and claims to the assets in case of bankruptcy. So if a company decides to pay dividends, then it has to pay dividends to the holders of the preferred stock first, before paying dividends to the holders of the common stock. Common stock is one of the main sources of capital for companies, especially for younger companies that don't have access to private and public debt. Companies issue and sell stock to investors and receive capital in exchange. Common stock represents ownership in the company, and it usually carries with it the right to vote on business matters, such as electing board of directors and establishing corporate objectives. Usually, common stock has a par value, which is a nominal price of the stock. This nominal price has nothing to do with the price that investors pay to purchase the stock from the company. The difference between the nominal price and the price that investors paid for the stock is recorded as additional paid-in capital on the balance sheet. So, additional paid-in capital represents the value of the common stock in excess of the par value. Treasury stock is the value of shares that a company has repurchased from investors. So, a company may actually repurchase its own shares, and this will be recorded as treasury stock on the balance sheet of the company. Note that the share price will reduce the number of shares outstanding that company has. If we take a look at the shareholders' equity of Adobe, we can see that, first of all, Adobe has 2 million preferred shares authorized to be issued. However, it hasn't issued any so far. So, Adobe's preferred stock is 0 in the year 2020. Next is Adobe's common stock at par value, which is shown as 0 on this financial report. And the reason why is because Adobe's par value is immaterial. Note that Adobe's common stock's par value is 0.0001 per share, and the total shares issued is 601 million. If we multiply these two numbers, we will get 60,000, which is immaterial compared to the total stockholders' equity of 13 billion. Next, we've got the additional paid-in capital, which is roughly 7.4 billion in 2020. And this is the value of the common stock in excess of the par value, which is 0 in this case. And finally, note that common stock includes shares issued of 601 million and shares outstanding of 479 million in 2020. So, the difference of 122 million shares shown in the treasury stock is the number of shares that Adobe bought back from the market. The value of the shares that the company bought back is 13.5 billion. Indicating that the company's share price has been performing well since the value of the treasury stock is greater than the value of additional paid-in capital. Also note that treasury stock is contra equity account and therefore its value is reported as a negative number. Let's review an example of the common stock accounting so we can get a better understanding of it. According to the instructions, we have to assume that the company sold 100 shares at $10 each at the beginning of year 1. Those 100 shares have a par value of $1 per share. At the end of year 3, the company repurchased 10 shares at 15. And we have to show the cash balance from the sale of common stock, the par value, additional paid-in capital, treasury stock, and total stockholders' equity. And we have to assume that the cash balance is only affected by the operations with common stock. So there is no other operation that can impact the cash balance except the sale of shares to investors. We start with the cash balance, and since we sold 100 shares at 10, this means that we were able to raise 1,000. So the cash balance will be 1,000 in year 1. The common stock par value will be 100, which is 100 shares times the value of $1 per share. And then the additional paid-in capital will be the difference between the money raised from the sale of stock, which is 1,000, and the common stock par value of 100. So the additional paid-in capital will be 900. Since the company did not buy back any shares in year 1, the treasury stock will be 0. The total shareholder equity will be the sum of the common stock par value, additional paid-in capital, and treasury stock, which is 1,000. Note that when we issue the shares, this affects our assets, which is cash, and stockholders' equity, which is par value and additional paid-in capital in this case. In year 2, the cash balance does not change because the company did not perform any operations with shares. The common stock par value and additional paid-in capital will also remain unchanged. And finally, the treasury stock is still 0, since the company did not repurchase any shares. So, the total shareholder equity will be 1,000 in year 2. According to the instructions, the company repurchases 10 shares at 15 in year 3. That means that the company has to spend 150 of cash to buy back its own shares. So, the cash balance will decrease to 850. The common stock par value and additional paid-in capital are not affected by the share buyback, so they will remain 100 and 900 respectively. The treasury stock, however, will now be negative 150. Remember that the treasury stock represents the value of the shares bought back. Since it's a contra equity account, it appears with a negative sign. The total shareholder equity will be the sum of the common stock par value, additional paid-in capital, and treasury stock. So the total shareholder equity will be 850 at the end of year 3. Having discussed the preferred stock, the common stock, and the treasury stock, we can now examine another source of financing of companies, which is retained earnings. Retained earnings is an approximate value of the internally generated funds available to companies because it's an accounting number as opposed to being cash. It represents the accumulated earnings of a company, which is accumulated net income. Since the net income is based on accrual accounting, the retained earnings are also based on accrual accounting. Therefore, the accumulation of the net income, or earnings, will be an approximation of the internal funding that the company generates. Note that the retained earnings link the income statement to the balance sheet. That's because when the revenue of a company increases, it increases the retained earnings, and this happens via net income. Revenue increases net income, and net income increases retained earnings. The opposite is true for expenses. When expenses increase, they decrease retained earnings because they decrease net income. So there's a link between the income statement and the balance sheet, and that link is retained earnings. In terms of the accounting for retained earnings, we start with the opening balance. We add the net income, or obviously, if the company generated a loss, then we will add the loss with a negative sign, which will reduce retained earnings, and then we have to deduct the preferred and common dividends. So, retained earnings opening balance plus net income less dividends will get us to retained earnings closing balance. Let's take a look at the example of Adobe. And we can see that Adobe reported retained earnings of $19.6 billion in 2020. To better understand the retained earnings, let's go over the example of the retained earnings. So, we have to assume that the company had a net income of $1,000 in year 1, $500 in year 2, and a loss of $300 in years 3 and 4. Next, the company paid common dividends of $100 in years 2, 3, and 4. And the task is to show the retained earnings balance, and we have to assume that the retained earning balance is 0 at the beginning of year 1. So in year 1, according to the instructions, the retained earnings opening balance is 0, the net income is 100, and the company does not pay any dividends in year 1, so it will be 0 as well. The retained earnings closing balance will be the opening balance plus the net income and less the dividends. So the retained earnings closing balance in year 1 will be 100. In year 2, the retained earnings opening balance is 100 because the opening balance is always equal to the closing balance in the previous period. According to the instructions, the net income is 500. The company pays a dividend of 100 in year 2. The dividend will have a negative sign because it reduces the retained earnings balance. The retained earnings closing balance will be the opening balance of 100 plus net income of 500 and less the dividends of 100. So it will be 500 in year 2. We start with the retained earnings opening balance of 500 in year 3. The company makes a loss of 300 in year 3, and the dividends paid is 100. The retained earnings closing balance will be the opening balance of 500, less the loss of 300, and less the dividends of 100. So the retained earnings closing balance is 100 at the end of year 3. In year 4, the retained earnings opening balance is 100. The company makes the loss of 300 again, according to the instructions. The dividend paid is 100 in year 3. The retained earnings closing balance will be negative 300, which is the opening balance of 100, less the loss of 300, and less the dividends of 100. So you can see that retained earnings actually can turn negative on the balance sheet of companies. In some jurisdictions outside the US, dividends are not allowed if retained earnings are negative. Let's now turn to the last item that we saw on Adobe's balance sheet, which is other comprehensive income or loss. Other comprehensive income or loss includes revenue, expenses, gains, and losses that do not appear on the income statement. These are the gains and losses related to such items as foreign currency translation, unrealized gains and losses on investment or derivative securities, and pension plan gains or losses. So, only unrealized gains or losses are recorded in the other comprehensive income or loss. If we go back to the example of Adobe stockholders' equity, we can see that the accumulated other comprehensive loss was $158 million in 2020. The calculation of the other comprehensive income or loss is shown on the consolidated statements of comprehensive income. This is the additional financial statement that companies release, in addition to the income statement, balance sheet, and cash flow statement. Typically, when analysts perform the financial analysis and financial modeling, they do not analyze the consolidated statement of comprehensive income for the simple reason that it's too difficult to predict the items included in the report. However, we have to know that such a financial statement exists so we understand where this other comprehensive income or loss is coming from. The consolidated statement of comprehensive income starts with net income that comes from the income statement. And then there are a number of adjustments and unrealized gains or losses related to available for-sale securities, derivative contracts, and foreign currency translation. We can see that the total of these unrealized gains and losses and adjustments amounted to $30 million in 2020. And then adding this to the net income will get us to the total comprehensive income.